About the only economic break most Americans have gotten in the last 6 months has been the drastic drop in the price of oil, which has fallen even more precipitously than it rose. In a year's time, a commodity that was theoretically priced according to supply and demand doubled from $69 a barrel to nearly $150, and then, in a period of just 3 months, crashed along with the stock market. So what happened? It's a complicated question, and there are lots of theories. But many people believe it was a speculative bubble, not unlike the one that caused the housing crisis, and that it had more to do with traders and speculators on Wall Street than with oil company executives or sheikhs in Saudi Arabia. To understand what happened to the price of oil, you first have to understand the way it's traded. For years, it's been bought and sold on something called the Commodities Futures Market. Here at the New York Mercantile Exchange, it's traded alongside cotton and coffee, copper and steel by brokers who buy and sell contracts to deliver those goods at a certain price at some date in the future. It was created so that farmers could gauge what their unharvested crops would be worth months in advance, so that factories could lock in the best price for raw materials, and airlines could manage their fuel costs. But more than a year ago, that market started to behave erratically, and when oil doubled to more than $147 a barrel, no one was more suspicious than Dan Gilligan.
We have to make sure that the futures market is an honest market.
As the president of the Petroleum Marketers Association, he represents more than 8,000 retail and wholesale suppliers, everyone from home heating oil companies to gas station owners. When we talked to him last summer, his members were getting blamed for gouging the public, even though their costs had also gone through the roof. He told us the problem was in the commodities markets, which had been invaded by a new breed of investor.
Approximately 60 to 70% of the oil contracts in the futures markets are now held by speculative entities, not by companies that need oil, not by the airlines, not by the oil companies, but by investors that are looking to make money from their speculative positions.
They don't actually take delivery of the oil.
All they do is buy the paper and hope that they can sell it for more than they paid for it before they have to take delivery.
They're trying to make money on the market for oil.
Absolutely, on the volatility that exists in the market. They make it going up and down.
He says his members in the home heating oil business, like Sean Coda of Bellows Falls, Vermont, were the first to notice the effects a few years ago, when prices seemed to disconnect from the basic fundamentals of supply and demand. Coda says there was plenty of product at the supply terminals, but the prices kept going up and up.
We've had 3 price changes during the day where we pick up products, actually don't know what we paid for it, and we'll go out and we'll sell that to the retail customer, guessing at what the price was. The volatility is being driven by the huge amounts of money and the huge amounts of leverage that is going into these markets.
About the same time, hedge fund manager Michael Masters reached the same conclusion. Masters' expertise is in tracking the flow of investments into and out of financial markets, and he noticed huge amounts of money leaving stocks for commodities and oil futures, most of it going into index funds betting that the price of oil was going to go up. Who is buying this paper oil?
California Pension Fund, Harvard Endowment, lots of large institutional investors. And by the way, other investors, hedge funds, Wall Street trading desk, were following right behind them, putting money, sovereign wealth funds were putting money in the futures markets as well. So you had all these investors putting money in the futures markets, and that was driving the price up.
In a 5-year period, Masters said the amount of money institutional investors, hedge funds, and the big Wall Street banks had placed in the commodities markets went from $13 billion to $300 billion. Last year, 27 barrels of crude were being traded every day on the New York Mercantile Exchange for every 1 barrel of oil that was actually being consumed in the United States.
We talked to the largest physical trader of crude oil, and they told us that compared to the size of the investment inflows, and remember, this is the largest physical crude oil trader in the United States, they said that we are basically a flea on an elephant. That's how big these flows were.
Yet when Congress began holding hearings last summer and asked Wall Street banker Lawrence Eagles of J.P. Morgan what role excessive speculation played in rising oil prices, the answer was little to none.
We believe that high energy prices are fundamentally a result of supply and demand.
As it turns out, not even J.P. Morgan's chief global investment officer agreed with him. The same day that Eagles testified, this email went out to clients saying an enormous amount of speculation ran up the price, and $140 in July was ridiculous. If anyone had any doubts, they were dispelled a few days after that hearing, when the price of oil jumped $25 in a single day. September 22nd.
September 22nd.
Michael Greenberger, a former director of trading for the Commodity Futures Trading Commission, the federal agency that oversees oil futures, says there were no supply disruptions that could have justified such a big increase.
Did China and India suddenly have gigantic needs for new oil products in a single day? No, everybody agrees supply-demand could not drive the price up $25, which was a record increase in the price of oil. The price of oil went from somewhere in the 60s to $147 in less than a year. And we were being told on that run-up, it's supply, demand, supply, demand, supply, demand.
A recent report out of MIT analyzing world oil production and consumption also concluded that the basic fundamentals of supply and demand could not have been responsible for last year's run-up in oil prices. And Michael Masters says the U.S. Department of Energy's own statistics show that if the markets had been working properly, the price of oil should have been going down, not up.
From quarter 4 of 07 until the second quarter of 08, the EIA, the Energy Information Administration, said that supply went up, worldwide supply went up, and worldwide demand went down. So you have supply going up and demand going down, which generally means that price is going down.
And this was the period of the spike.
This was the period of the spike. So you had the largest price increase in history during a time when actual demand was going down and actual supply was going up during the same period. However, the only thing that makes sense that lifted the price was investor demand.
Masters believes the investor demand for commodities and oil futures in particular was created on Wall Street by hedge funds and the big Wall Street investment banks like Morgan Stanley, Goldman Sachs, Barclays, and J.P. Morgan, who made billions investing hundreds of billions of dollars of their clients' money.
The investment banks facilitated it. They found folks to write papers espousing the benefits of investing in commodities. And then they promoted commodities as a quote-unquote asset class. Like you could invest in commodities just like you could in stocks or bonds or anything else. Like they were suitable for long-term investment.
Dan Gilligan of the Petroleum Marketers Association agreed.
Are you saying that companies like Goldman Sachs and Morgan Stanley and Barclays have as much to do with the price of oil going up as Exxon or
absolutely.
Shell?
Yes. I tease people sometimes that, people say, well, who's the largest oil company in America? And they always say, well, ExxonMobil or Chevron or BP. But I'll say, no, Morgan Stanley.
Morgan Stanley isn't an oil company in the traditional sense of the word. It doesn't own or control oil wells or refineries or gas stations. But according to documents filed with the Securities and Exchange Commission, Morgan Stanley is a significant player in the wholesale market through various entities controlled by the corporation. It not only buys and sells the physical product through subsidiaries and companies that it controls, Morgan Stanley has the capacity to store and hold 20 million barrels. These storage tanks behind me in New Haven, Connecticut, hold Morgan Stanley heating oil bound for homes in New England, where it controls nearly 15% of the market. The Wall Street bank Goldman Sachs also has huge stakes in companies that own a refinery in Coffeyville, Kansas, and control 43,000 miles of pipeline and more than 150 storage terminals. An analyst at both investment banks contributed to the oil frenzy that drove prices to record highs. Goldman's top oil analyst predicted last March that the price of a barrel was going to $200. Morgan Stanley predicted $150 a barrel. Both companies declined our request for an interview, but maintain that their oil businesses are completely separate from their trading activities and that neither influence the independent opinions of their analysts. There is no evidence that either company has done anything illegal.
Is there price manipulation going on?
I can't say, and the reason I can't say is because nobody knows. Our federal regulators don't have access to the data. They don't know who holds what positions.
Why don't they know?
Why don't they know?
Yeah.
Because federal law doesn't give them the jurisdiction to find out.
It's impossible to tell exactly who is buying and selling all those oil contracts because most of the trading is now conducted in secret, with no public scrutiny or government oversight. Over time, the big Wall Street banks were allowed to buy and sell as many oil contracts as they wanted for their clients, circumventing regulations intended to limit speculation. And in 2000, Congress effectively deregulated the futures market, granting exemptions for complicated derivative investments called oil swaps, as well as electronic trading on private exchanges.
Who is responsible for deregulating the oil future market?
You'd have to say Enron. This was something they desperately wanted, and they got.
Michael Greenberger, who wanted more regulation while he was at the Commodity Futures Trading Commission, not less, says it all happened when Enron was the 7th largest corporation in the United States.
This was when Enron was riding high, and what Enron wanted, Enron got.
Why did they want a deregulated market in oil futures?
Because they wanted to establish their own little energy futures exchange through computerized trading.
He's going to pay me $0.015.
They knew that if they could get this trading engine established without the controls that have been placed on speculators, they would have the ability to drive the price of energy products in any way they wanted to take it. When Enron failed, we learned that Enron and its conspirators who used their trading engine were able to drive the price of electricity up, some say by as much as 300% on the West Coast.
Is the same thing going on right now in the oil business?
Every Enron trader who knew how to do these manipulations became the most valuable employee on Wall Street.
But some of them may now be looking for work. The oil bubble began to deflate early last fall when Congress threatened new regulations and federal agencies announced they were beginning major investigations. It finally popped with the bankruptcy of Lehman Brothers and the near collapse of AIG, who were both heavily invested in the oil markets. With hedge funds and investment houses facing margin calls, the speculators headed for the exits.
From July 15th until the end of November, roughly $70 billion came out of commodities futures from these index funds. In fact, gasoline demand went down by roughly 5% over that same period of time. Yet the price of crude oil dropped more than $100 a barrel. It dropped 75%.
How do you explain it?
By looking at investors. That's the only way you can explain it.
The regulatory lapses in the commodities market that many believe fomented the rapid speculation in oil have still not been addressed, although the incoming Obama administration has promised to do so.